We had another up session for stocks today. In fact, this is our 7th day in a row to the upside on the S&P 500 since producing those back-to-back oversold cluster signals here a couple of weeks ago. While we were only up 0.3% today, it's the consistency of this move off of those oversold conditions that has been impressive. This 7-day rally matches the 7-day rally that we saw back in July. So these types of moves do not happen all that often. Today, it was once again led by the Magnificent Seven as it was yesterday. So we really saw a lot of outperformance amongst technology and discretionary today, whereas other areas like utilities and REITs and even energy started to roll over a bit. So we'll talk about all of that tonight. We'll take a look at our sector selector to see if we have any sector rotation to be aware of. We'll take a look at where our macro conditions are and some of the charts that are breaking down, including oil and including interest rates and the US dollar, and see what that means for our posture across other indices. And then we'll get into our trade application example, where we'll feature a short sale on a cable-oriented company that appears to be bouncing down and away from its falling 30-day moving average. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's Election Day, November 7th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also see which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter, or what they refer to as X these days. My handle is @BrandonVanZ. We really appreciate those of you that click like and repost on those different market outlook related content. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. As you can see, I've got the heat map pulled up for the S&P 500 here, and it was a bit of a mixed session today. We actually ended up having a fairly nice rally from the S&P 500 perspective, mostly because the mega caps were leading the way here today. Remember, we've had a few of those days last week and the week before where it was kind of the opposite, where the rest of the market was carrying the Magnificent Seven. But here yesterday and today, it kind of feels like that momentum swayed back towards those Magnificent Seven companies once again. So they're kind of pulling more than their weight for this market at this exact moment in time. Let's go through some of the information we see here. Get started with Microsoft in the upper left-hand corner. Beware that Microsoft actually overtook Apple in market cap at one point last week. I don't know if that's still the case. They're kind of neck and neck at this point, but sometimes people, I think, forget about Microsoft because it's maybe a little bit more fun to talk about, Apple and all their exciting consumer gadgets like the iPhone and all that kind of stuff. A little bit less fun to talk about Microsoft's Office product. I suppose you could go the direction of Xbox and their cloud computing and different things like that. But nonetheless, Microsoft is a powerhouse these days, right? Just as big and as important as Apple. Today, Microsoft was up 1.12%. and Apple was up 1.45%. So they didn't have a whole lot of separation away from each other today. But the good news is they were both up nicely and easily outperformed the overall market, which was up about 0.3%. So again, a recognition that it's the mega caps that are really carrying the weight here today. Sticking with the Magnificent Seven within the technology sector, NVIDIA was up today as well. Stock's been a bit more hit and miss, it seems, in the last couple of months compared to how it was just firing out of the gate at the beginning of the year. Nonetheless, still maintains a huge market cap and is up about 0.5% here today. Alphabet had a reasonable day in the communications area. It was up 0.72%. Meta was up 0.96%. Down below now into the consumer cyclicals. For the discretionary area of the Magnificent Seven, Amazon was up 2.13%, which was actually the best of the Magnificent Seven today. And Tesla was at a rally of 1.33%. So you can see there that of our Magnificent Seven, all 7 of them closed in the green. not only did they all close in the green, but all 7 of them outperformed the S&P 500's end result here today as well. And so when we have a day like that, you should assume that when you look at the rest of the market, it doesn't look quite as rosy. And that was the case here today. As you can see, we kind of have a heat map where it seems like the lower right-hand corner is red, the upper left-hand corner is green. And so let's go ahead and talk about a few more of the green ones that kind of stood out here today. Adobe had a nice day, up 3.5%. Broadcom, Intel, some of those semiconductor companies made a decent move today. We had Salesforce and Intuit, both up over 2% in the software space, so that was good to see. A handful of the healthcare stocks were up today. Eli Lilly was up 0.8%, of course, close to all-time highs there on their weight loss drugs. I should point out that you don't see the CRISPR stocks listed here because none of the CRISPR stocks, at least the pure CRISPR stocks, are big enough to be in the S&P 500. But some of you may have noticed that our trade application example, where I bought calls on CRISPR in this trade application example for this video a month or two ago, has really had one heck of a run. CRISPR's up about 50% in 2 weeks after their AdCom FDA panel here a couple of weeks ago. So that stock or those calls are now nicely profitable for us, I might add. So that's kind of been one of the more exciting areas within healthcare, but you don't see it within the S&P 500 because none of those companies are big enough. All of those pure CRISPR companies are below $10 billion market caps, which is part of the reason they can move so quickly, both on the upside and the downside. A few others within healthcare that did reasonably well today. Humana had a good day, up over 2%. We also saw Zoetis have a good day, up over 2%. Moderna up over 2% as well. Over here in the consumer staples area, I see Estee Lauder up over 2%. That stock has been really hit hard here over the last couple of years. So a little bit of a rally today, but that's not going to heal too many wounds of folks that are involved in that particular name there. Down below here, in some of the more discretionary areas, there's a little bit more of this bright green patches, including Airbnb up over 2% today, Royal Caribbean up nearly 3%. We saw Nike up 2% today. Even the home builders rallying. I think D.R. Horton had their earnings announcement here recently. They were up about 3% today. Of course, we've been watching interest rates, and that's part of what has spurred on this rally that we've seen here over the last couple of weeks is interest rates have topped out to a degree, and therefore we did find a bit of kind of stability within the mortgage market as well as those rates have pulled back just a little bit, so maybe giving some enthusiasm to the home builders there. A couple of other consumer-related names. Church & Dwight was up 2% today. We also saw Clorox, a dividend aristocrat company, up nearly 3% today, as well as some of those retailers themselves like Walmart, Costco, Dollar General. Those companies all seem to close slightly in the green here today as well. Let's talk about those that didn't fare quite as nicely now. And you can see, as I mentioned before, what shows up, at least to me initially, is that a big portion of the red squares and rectangles are in the lower right-hand corner. And the brightest of the red are the ones in the energy sector. Notice that Chevron and Exxon, both down over 1%. In fact, it was a little bit strange that the other day when I was going through 52-week high and 52-week low lists, I happened to notice that Chevron was on the 52-week low list, which caught me by surprise because, as many of you know, I use those dividend stair-step charts to kind of get a feel for long-term investing. And Chevron is still trading closer to the orange overvalued zone, even though it's at a 52-week low. And that doesn't happen very often. And typically when it does happen, it's a case like this where the stock went up so much a couple of years ago that even though it's at its lowest price in over a year, it's still up huge from where it was 2 or 3 years ago, and therefore kind of in the neutral area now on the dividend stair-step chart. But naturally, if Chevron or Exxon, both of them being aristocrats in the energy patch, got down to those blue areas once again, we'd have no problem taking a look at them and seeing if there was some opportunity there. There was an interesting post on Twitter here yesterday that I had responded to of some college students, it looked like debating, or maybe that's not quite the right word, perhaps just protesting not to use oil, and they were basically, trying to break the frame of this oil painting is what it looked like to me. I didn't catch the whole story, but it was apparently in a museum. But what was interesting about it is they were both wearing tennis shoes, and of course, some folks forget that without oil, our current modern world cannot operate the way that it does, and those very tennis shoes that those kids were wearing would not be possible without oil that they are protesting. So naturally, that's a bit of a bipolar topic. Some people are really anti-oil, some people are very pro-oil. I hope most of us are somewhat in the rational and logical category in the middle, where we recognize its value, but at the same time, hopefully we also will look towards the future, and hopefully we don't destroy our entire environment in an effort to modernize our society. So hopefully we find ourselves some nice middle ground there. But even if the world moves to electric vehicles, there are still going to be tons and tons of uses for oil, including the roads and the asphalt that the electric vehicles will drive on. They're made out of oil. So anyway, kind of interesting debate that we've seen pop up here and there. Seems to be a little bit more of a hot button issue right now, with inflation running hot, and of course Middle East in focus with what's going on over in Israel and what have you. But a lot of the oil companies really took it across the chin today. Notice that Conoco was down almost 3%. Schlumberger was down 5.5%. We actually sold that stock just yesterday in our top-down trend trading class, where we had been trend trading it to the upside, but each week we kick one of the weaker players out of our portfolio. Sometimes that comes back to haunt us, but this time around, I must say I'm happy that we decided to cut bait on Schlumberger, knowing what happened to it here with 2020 hindsight a day later, with it really collapsing pretty large, over 5% in that case. So they certainly weren't alone. Most of the oil companies were in the red here today. There were some industrial companies that really fell today as well. Emerson, which is a dividend aristocrat and king, had their earnings report, and apparently market participants did not like what they saw out of it. Stock was down 7%. But kind of a similar situation as Chevron, where that stock has done so well over recent years. It had been an overbought, overvalued territory on the dividend stair-step chart. So today it's trying to kind of rectify that. And speaking of the dividend stair-step charts, a reminder that every Tuesday morning I teach my dividend growth investing class, where we build out portfolios based upon those dividend stair-step charts. And so today's class was focused on the utilities sector, where we're adding our second utility to this current semester's portfolio, after utilities, of course, have had a tough go of things in recent months, but have more recently started to stabilize once again. So if you're a premium member of Market Scholars, you're welcome to go check out that recording if you weren't able to attend the class live with me here this morning. If you're not a premium member of Market Scholars, friendly reminder that we will be having our Black Friday sale coming up here in a couple weeks, and therefore might as well save a few bucks if you're planning on joining our services, which we'd love to have you. Other industrials that fell today, including Deere down over 2% and Caterpillar down 1.4%. And both of those, interestingly enough, also fall into that same conversation of Emerson and Chevron, where they've done so well in the last few years. They were in overvalued territory, and therefore probably not the best of ideas to put new money into them until we can prove that on a historical basis their yields are attractive enough. Same thing can be said here for, where was it? Here it is, Air Products. Some of you saw my post on Twitter earlier today, because Air Products was the worst performing stock in the entire S&P 500, down 12%. It is also a dividend aristocrat company, but like a lot of those others, it has spent more time in the overvalued zone here in recent years than in the undervalued zone. And even after today's 12% pullback, it still is not into the blue zone of the dividend stair-step chart. Now, it's closer than like Chevron and Deere in a couple of those. So this is one that I want to keep a close eye on, and it is entirely possible within the next month or two we might very well see that back in the blue zone, and that one is pretty rare in the blue zone. It's generally perceived as a fairly high quality business. So if you're interested in dividend growth investing, keep APD on your radar here, and maybe if we can get a steeper discount in the share price, it'll be attractive long-term candidate moving forward. A lot of other materials companies down. I see Freeport-McMoRan in the copper space down almost 4%. There's Newmont Mining in the gold space down 3%. Most of the utilities were down today, and most of the REITs were down today as well. So again, a lot of these smaller sectors had the vast majority of their components in the red today, yet the S&P 500 was up for like its 7th straight day or whatever it was, and it was largely on the back of those mega cap Magnificent Seven types of companies that were out there. Let's take a look at the actual breadth number now and pop on over here to the Thinkorswim platform. And hopefully those of you that went through your Schwab transition over the weekend, the transfer and everything worked out as expected. Naturally, there are things that will crop up that were unexpected, and we ran into a few of those things with some of our charts and things like that here as well. So all struggling through it together, but reminder that I believe it's next March when the final transfers will take place. So many of you are still at TD Ameritrade and will eventually be pushed over to Schwab if that has not happened quite yet. And at that time, your Thinkorswim login will change as well if you use Thinkorswim like we do here in these presentations. So just make sure you're doing your best to prepare for that wherever possible. Anyway, here on the Market Watch Visualize area, you can see I've got the S&P 500 pulled up. And we've got, looks like 210 out of the 500 stocks in the S&P 500 closing in the green today. So that's about 42%. So again, remember what we just looked at there a second ago on the heat map. There were more red squares and rectangles than green squares and rectangles. This is proving that out right here. So today, the breadth of the market was not as good as it was on some of those days last week when the exact opposite was taking place. Today was a day where you had a minority of stocks that closed in the green, but the overall index managed to close in the green anyway because the most important stocks were the ones closing in the green with the biggest market caps, with the S&P 500 being a market cap weighted index. Let's go ahead and pop on over here to our charts now, do a bit of analysis there. This is chart 4B. Reminder that when you become a 3-year premium subscriber of Market Scholars, you get access to all 50 plus of those customized ThinkScript charts that you see David and I using in these presentations and in our daily trading rooms and classes that we teach our premium members as well. So this chart 4B will basically just be a 4-grid that has ThinkScript programming designed to tell us on the chart based upon color coding whether we have bullish, bearish postures or what have you. And so when you have a green background over the current candle, that means we have a bullish intermediate posture. Remember, technically, there's multiple lines on the market forecast technical indicator, including the red momentum line, the blue near-term line, but it's the green intermediate line that we are referencing when you just hear us say generically what the posture is. Unless you hear us say otherwise, just assume that we are talking about the green intermediate line. And in this particular case, we can now say for the first time in a really long time that all 4 of these charts have strongly bullish intermediate postures. We can say that now finally because the Russell 2000 finally went to that darker shading of green, right? The last couple of days prior to today, it had already gone to the light shading of green, which is when this green line will emerge out of that lower reversal zone, but not quite pass the 50th percentile on the way up. Today, by the slimmest of margins, it was able to do that. So it's precarious at best right here, and it might not last, but at least for one day we can make that claim. You'll notice that in the label, it shows that the reading is at 50.17. So remember, if it were at 49.99, then it would still be a light green background color. So by the slimmest of margins, we can make that claim that all 4 of our charts currently have strongly bullish postures from an intermediate perspective according to the market forecast technical indicator. In the case of the Russell 2000, by the way, you'd have to go back exactly 3 months since the last time you could say that it was in that strongly bullish territory, and starting tomorrow, that will no longer be the case because, of course, this is a rolling 3-month chart here. So just ironically, it was exactly 3 months ago you had that dark green color there, and then starting tomorrow, we will no longer see that. It will be all of this light red and darker red shading here along the way. So anyway, point is, it's been several months, especially for the small caps, since you've had any semblance of strength. But finally, they are coming along for the ride, even if they're being dragged higher by the large cap indices, which is kind of the feeling of it right now. I don't know how much you can believe in the small caps when they were actually down today and yesterday, right? So today they were down 0.28%, and you'll notice out of these 4 different indices, the small cap Russell 2000 was the only one in the negative. All the rest were positive here today, even though some of the others struggled in the morning. They were able to overcome those challenges in the afternoon and close higher, but the Russell 2000 was not. So they've had 2 days in a row to the downside at the same time when these other indices are working on like 7-day win streaks, right? For the S&P 500, it's 1, 2, 3, 4, 5, 6, 7 days in a row to the upside immediately after those 2 oversold cluster signals that we identified here just a couple of weeks ago. So if some of you are newer to the videos, you might not kind of understand how important those oversold cluster signals are on the indices themselves, especially the S&P 500. And we tried to let you know how important it was by letting you know that these were literally the first cluster signals in over a year. So in other words, we went an entire year without a single oversold cluster signal. We finally got 2 of them in a row, and wouldn't you know, we went on one of our biggest win streaks in a couple of years, 7 days in a row to the upside. Where we ended, by the way, on the S&P 500 is up here at a little bit of a precarious spot with the this kind of consolidation area here in mid-October catching my eye. And we kind of stalled out just where a lot of those candles stalled out as well. So maybe that will be used as an excuse by the bears to try to make a stand right here. I don't know how resilient they will be because there's a lot of momentum behind the market right now, but it wouldn't be entirely surprising to see a down day in the market after such a robust move now that there's kind of a technical excuse to kind of stall out at around these areas. But remember, we're now in the seasonally strong time of year as well, so hopefully the tide will kind of turn towards more bullishness as opposed to more bearishness. And even if it doesn't happen as soon as tomorrow or this week, that hopefully there will be more of a push higher well above that level as we head into the end of the year when we get the traditional Santa Claus rally and different things like that. So we'll see. Every year's a little different. That's the whole point of watching these videos as often as you do, is it allows you to kind of check in and kind of get into the mind of David and myself when we're producing these videos as to what is catching our eye. And we've been quite pleased, at least I have as a long-term investor, to see this 7-day rally right here. It's been long overdue is the way it felt to me, that's for sure. So it's nice to see a little bit of resilience out of the bulls here, and hopefully that is a sign of good things to come now that we're in the seasonally strong period of the year. So S&P 500 up 0.28% today, strongly bullish intermediate posture, and is trading above a rising 30-day moving average. So notice that is the case for 3 out of 4 charts. So all 4 of our charts have strongly bullish postures, as I mentioned just a moment ago. But notice that the Russell 2000 still has a yellow moving average, The other three have green moving averages. Remember what that means is price is above a rising moving average. In the case of the Russell 2000, price is above the moving average, but the moving average itself is still falling. So it's not as bullish. That's yet another way to identify that the small caps have not been able to keep up at the same pace as the large cap other indices that are out there. Those indices are so strong in the last couple of weeks, you're literally bending the 30-day moving average up alongside of these rallies, which is a powerful statement for the bulls out there. The Dow, by the way, was up 0.17% today. The NASDAQ was up 0.9% today. So the NASDAQ was today's big winner. No surprise there, given what we saw on the heat map where it was the tech stocks that were easily leading the way in the market today. And remember, you have your highest concentration of tech stocks in the NASDAQ composite compared to these other indices that are out there. Let's go ahead and take a look here at our 3 green arrows status now. This will be chart 4D. A reminder that the background colors of this chart setup mean something different than the last one. In this case, when you see a green background color, it means that we have a 3 green arrows signal. Some of you that were with David and I back at our old Invest Tools days 5+ years ago before we started Market Scholars will recall that language that was used of 3 green arrows. Basically just means there's 3 different technical indicators and they're all lining up bullishly at the same time. The 3 technical indicators in question are the 30-day moving average, the MACD histogram, and the stochastic. And the background color of these charts on 4D here will tell you if we have 3 green arrows, 3 red arrows, or if there's a mix. So if the background color of the chart is white, that means that there's a mix of green and red arrows. If it's green, like it is with all 4 of our charts right now, it means that all 4 of these charts have a 3 green arrow signal here at the moment. So, you know, price is above moving averages, MACD histogram is telling us there's an acceleration of momentum, especially with these green bars that are plotted across the board with all of them except the Russell 2000. That's yet another way to identify the Russell 2000 is not quite as strong as the others. It does have a green arrow, but it has a gray bar on today's bar telling us that there's a little bit of a, you know, a shaving off of some of that momentum that's taken place here more recently. It's not a huge deal yet, but it's just a little bit of a warning sign that maybe it's kind of stalling out at around these levels. And then on the stochastics, we've got green arrows across the board. This is kind of scrunched up for some reason right now, so you can't really see them. But remember, if you maximize the cell, you can see those green arrows down below a lot easier there. So we've got our green arrow there on the S&P 500 on the stochastic as well. Remember what that's telling you basically is that price is trading near the highs of recent price ranges, which is a bullish feature as well. So 3 green arrows on all 4 of our charts right now. Let's also take a look at our longer term chart now, our 1040 crossover method chart. This is chart 4C for those of you that are premium members following along at home. This is a little bit more of a mixed bag, right? The other charts that we've looked at, which are shorter term charts, are all kind of together. They're all moving in the same direction. But when we expand our view a little bit longer in time, and remember that these charts are 3-year weekly charts, different than the 3-month dailies that we were just looking at. So this will let us see a much broader stretch of time here. And you can see that does have an impact depending upon which of these indices you are looking at. On the left-hand side here, where we've got the S&P 500 and the NASDAQ composite, notice that both of those have green background colors. And on this chart, what that means is that the 10-week moving average, represented by the orange line, is above the 40-week moving average, represented by the blue line. So since the orange line covers fewer candles, it is more sensitive, so it can change more quickly. And when it changes more quickly to the upside, that's generally perceived as a bullish thing because, again, it means that people are piling into the stock market. So with the S&P 500 and the NASDAQ composite, we are still in that what we would refer to as a golden cross territory. Again, remember that each one of these candles is 1 week in time. Some of you might also alternatively use a 50-day moving average and a 200-day moving average with your crossover charts, which is effectively telling you the same thing. So whether you use 50, 200-day or whether you just condense it down to a 10-week and a 40-week, you're looking for those crossovers of those moving averages. And in the case of the S&P 500 and the NASDAQ, it remained bullish this entire time. So it was able to withstand that pressure of the pullback that we experienced in the fall, and we never did have a crossover. We got really close 2 weeks ago. You can see here, if I right-click, maximize this, that this 10-week moving average, this orange line right here, almost came down to the blue line, but it was kind of saved by the bell. The last 2 weeks we've been ripping right back to the upside, so now there's a little bit more expansion there between the orange and the blue line. Remember, that's effectively what the PPO is telling you down below here. This is showing you the distance between those two moving averages. So notice that we had a little bit of a bounce in that green line down below, and since this is all happening above the zero line, it's basically meaning that there's a positive difference between those two colored moving averages you see on the chart. So for the S&P 500 and the NASDAQ composite, we've maintained those longer-term bullish views here basically ever since April in the case of the S&P 500, and it looks like it was the exact same time for the NASDAQ composite. Now talking about the two charts on the right, it's a little bit different, right? Because here you can see we've got a pink background color on both of those. In the upper right one, the Dow Jones Industrial Average, that pink color has been present for just the last couple of weeks, and you'll notice here that the orange line, so again, if I right-click and maximize this, you can see that the orange line did dip below that blue line there. So that's what we would refer to as a death cross, not a golden cross. But because this is kind of stabilizing very, very quickly after a crossover, it could end up being a head fake, right? We had a head fake over here as well, where that orange line went below the blue line for like 1 or 2 weeks, and we immediately pulled out of that condition. This has the potential of doing the same thing. That's how robust the trading has been in the last 2 weeks in the stock market. It has the potential of making this look like one of those head fakes. Again, it wasn't a head fake on the S&P 500 because you never had the crossover, but with the Dow Jones, it had been a little bit weaker as it doesn't have as much exposure to the Magnificent Seven, and so we'll see if it ends up being a head fake there or not. The conditions on the Russell 2000 are worse, right? If we right-click, maximize the sell here, you can see it was several weeks ago, going back to late September when that crossover happened, that death cross, and there really hasn't been an active attempt to rebound aggressively here. So this one I would not identify as setting up for a traditional head fake the way that is possible on the Dow Jones right now. There's more of a problem here on the Russell 2000, and you probably don't need me to tell you that because we've been talking about it for weeks, if not months at this point, right? It was just 3 weeks ago we hit literally a new 3-year low on the Russell 2000. So there is more selling pressure there. That is where the concern of the market is. The concern of the market is not with the mega caps nearly as much, but we definitely have some problems there with the small caps from a longer term perspective. So we want to keep our eye on that moving forward. All right, let's go ahead and pop on over here to the internet. As you probably are aware already, since we are now 30 minutes into the video, you guys knocked it out of the park for me. We were able to get up and over 100 likes easily on the last market outlook video that I did there on Twitter. So thank you to the 107 of you that clicked like. Remember, anytime we're at 100 or more, I will do an hour-long presentation for you. On the other hand, if we're under 100 likes, then we'll keep it at just 15 minutes like I did with the two videos last week. And by the way, I was looking earlier, we currently have, I think it's 8 open trades for this Market Outlook presentation that I do, and guess what? We're making money on all 8 of them. That was not the case before today with CRISPR. So CRISPR kind of bailed us out there. If you see here on the CRISPR position, we made $450 today, so that took us from being slightly underwater as of yesterday to now being profitable by $420 in one single day. Whether that lasts or not, anybody's guess, but I had to wait until today to claim that all of our trades are bullish right now. I'm bringing that up, by the way, because remember, when I do a hour-long presentation like I am doing right now, part of that hour is sharing a trade application example with you. When we only do the 15-minute video, there is no trade application example. And so I always try to put myself in your shoes, and if we have 8 trades going right now and all 8 of them are profitable, that's a pretty good track record, and those are free trades that I'm just, giving you on a silver platter. You don't have to pay a single cent for them. All I ask you in return is to click like for us on Twitter, and many of you are willing to do that. Many of you refuse to, and I don't think I'll ever be able to twist your arm enough. But hopefully, if you know that, like last week, there were 2 other trades that I would have otherwise presented to you that were skipped, that could very well be profitable trades as of right now as well. It makes you wonder. And if it only takes 5 seconds out of your day to help us, then hopefully many of you will help support us. So let's do some shout outs to some of those 107 that were willing to help me out last time around. Thank you to Lucius. Thank you to Ayakipa. Thank you to Ilan. Thank you to Anne and to Michael and George McClendon. And by the way, big thanks to George, because George was not even on Twitter before last week. And after hearing our call for support, he started questioning or asking us questions about that process. He says, I'm not really on Twitter, but I want to help you guys if I can. What do I need to do? And so I said, all you have to do is sign up for a free Twitter account and just click like. That's all there is to it. So he literally got on Twitter for the sole purpose of helping David and I with supporting these market outlook presentations. So George, you earned the gold star from us here today. Thank you for your support. Also, thank you to Ash and to Keola and to David and Jorge and Michael and Teresa and Barry and Hot Rod Rob and Susan and Sherry and Leah and Leo and others. Can't get to all of you, but hopefully every so often you hear your name shouted out there, and it just is a small way to recognize that we appreciate those of you that are out there taking that 5 seconds out of your day, helping spur along the possibility of us giving you more analysis, not less. And so continue to do that on your end, and we'll do our best to help support your learning efforts on our ends. But remember, these free videos on YouTube are completely voluntary, so we need to have your support. Otherwise, we're just not going to have any motivation for doing them. So I think many of you recognize that, and you're more than willing to help us out, and we really, really appreciate you. Thank you so much. All right, let's take a look now at our sector selector. This sector selector is something I put together on Friday evening, so it is a couple of days stale by this point from a trading days perspective, but can still give us a good idea as to what has been happening from a sector rotation perspective here more recently. So as of Friday, energy did maintain their number 1 position yet again. So remember, they have been number 1 now for, I think it's 14 straight weeks. This week, I don't know if they're going to be able to hold on based upon what we just saw here a little bit ago on the heat map with energy really underperforming today. I think it's starting to get a lot tighter in terms of the ranking. I think what's happened is energy had such a massive head start from outperforming dramatically a couple of months ago that even though it's kind of been a little bit more choppy in recent weeks, it's been able to hang on to that lead. But if we actually have days like today where the market is up and those energy stocks are some of the worst ones to the downside, there is a possibility that energy will no longer be up at the top here in coming weeks. So we'll keep our eye on that, and obviously if we get to 100 likes, we'll plan on sharing this information. That's another thing that we have to omit when we don't get to 100 likes, as was the case last week. So assuming we continue to get to the 100 likes, I'll be happy to continue sharing this sector selector with you in future presentations as well. And if there is a change up at the top, I'll be sure to let you know. But of course, keep in mind, all of you who are premium members of Market Scholars have access to this 24/7. And of course, we analyze it during my top-down trend trading class on Monday mornings as well. So energy remains at the top, but I would say their number 1 ranking is much more precarious in my mind than it has been in quite some time, and it would not be surprising to me at all if they give up the ghost there eventually. Utilities, a little bit more surprising to me that they were able to maintain strength last week. Right, the week before, it was interesting because of how big of a move that they had, but I kind of understood why that was the case, right? Interest rates stopped going up, so those interest rate sensitive securities had a big rebound as a result. I was curious last week if they'd be able to maintain that level because stocks across the board were just ripping higher, right? We talked about just one example, those CRISPR stocks are up like 33% in a week in some cases, right? So you can't really compete if you're a utility company to some of those biotech and more speculative things that are happening out there. So I was a little bit surprised to see utilities maintain the strength on a relative basis in order to stay at the number 2 ranking. Again, similar to my conversation with energy, I'm not sure how long that's going to last. It feels a bit precarious to me, but obviously every day brings new information. And if interest rates keep on falling, then all bets are off. Maybe they will stay strong. But I would be a little bit surprised if we have kind of a risk-on type of a rally like it feels like we've had recently, if utilities can maintain their relative strength in that. They might still have absolute strength, but it's the relative strength that we're analyzing here on this graphic. Financials did stay at number 3. There, it's largely a lot of insurance companies that are carrying the load. Many of the banks and some of the other areas like the asset managers really aren't firing on all cylinders. But the insurance companies look really strong. They have some of the better trends out there from a trend trading perspective. The exchanges also look quite strong. So it's kind of interesting to see the haves and the have-nots within the broader financial sector at the moment. Communications managed to go from number 5 up to number 4, basically a flip-flop with technology, which was at number 4 and went down to number 5. Now, interestingly enough, with technology, this is the first time it has been out of the top 4 in many, many months. It's basically been our leader most consistently in the full year of 2023. So I'd have to go back a long time since I last saw technology at this low of a position, and it's really not even that big of a deal, right? Technically, rankings 1, 2, 3, 4, and 5 are still in the upper half of the rankings when we're measuring 11 different things. So I don't want to unfairly, throw them under the bus or anything like that either, but it is just an interesting acknowledgement that their outperformance has not been as extreme as it had been earlier this year. So that was another interesting element of what we've seen here. You still have some of your more interest rate sensitive areas like staples and healthcare at the bottom, kind of trying to sort things out there on a relative basis. All right, let's get back on track with the Thinkorswim platform now. Pop back on over here and do some charting analysis. And we're going to do some 12 grid analysis now. Remember, that's another thing that I try to include when we do a full hour-long presentation like this that oftentimes is omitted on our 15-minute versions because there's just not enough time to do it all. So let's sink our teeth into chart 5A, and that will allow us to kind of see what's going on from an asset class perspective. Now, keep in mind when you're looking at these charts, we don't have the color switching effect on these charts like we did on the others I was showing you, not because it's not possible, but because everything gets scrunched up so much you can't make heads or tails of it. So the way that you read these charts is there's just one solid color, either green or pink, and when the charts are green, it means you have a bullish current posture using the intermediate line on the market forecast, and when the charts are pink, it means you have a current bearish posture using the intermediate line on the market forecast. So let's start in the lower 2 corners, as is oftentimes the case, and you can see part of the reason why the stock market is all of a sudden firing in all cylinders again. It's because the bottom 2 corners are starting to break down. Remember, during this run of interest rates and the US dollar strengthening for month after month after month, that's when stocks were falling month after month after month. But notice the difference in sentiment just within the last couple of weeks here, where you're looking at probably back here just over 2 weeks ago when U.S. Treasuries topped out, at least on the 10-year. Remember, it basically touched 5% that one day, and ever since then, it has now rolled over, and today we ended at 4.57%, so down nearly 50 basis points in just 2 weeks on the 10-year Treasury yield. That is a very aggressive move for interest rates that tend not to move all that aggressively. Usually the bond market and interest rates are pretty boring. They're yawners, right? But they have certainly captured the market's interest in recent years, mostly because of how aggressively interest rates have risen. But we are in one of those rare moments where interest rates have peeled back, and that's given an opportunity for risk assets like stocks to start moving higher once again. So at this moment, notice that we do have a bearish posture on 10-year Treasury yield. Our moving average is yellow because in this case, price is below a rising moving average. So those two things are opposing one another. But I would venture to guess that another 2 or 3 days where you have pressure on rates would be enough to pull this moving average lower, and then we'll start seeing it look red, like is the case, for example, right now on oil. Right? Oil had a bad day today, by the way, down 4%. Notice it was so bad that oil now has an oversold cluster signal. How rare is that, right? It's been a while. So let's maximize the oil chart here. You can see this is the full 3 months. We actually had an overbought cluster over here. I'm less interested in overbought clusters as I am oversold clusters, as I've mentioned to you guys countless times over the years. I think the evidence suggests that the likelihood of a reversion to the mean is better with oversold clusters, the green dots, than the similar concept with the red overbought clusters. But that's just one man's opinion. You can have your own opinion on that. I'm just merely sharing my experience with you. But let's go back on a 6-month chart now. And you can see this is actually the first oversold cluster signal for USO, which is what we use as a proxy for oil. So that way we can have kind of an ATF view of it. You could, of course, apply this to the oil futures contracts, but you have to deal with the rolling of those contracts, which kind of muddies the water a little bit. But anyway, on USO here, this is the first oversold cluster signal in at least 6 months. Let's go back now on a full year. And here you can see we did have 2 oversold cluster signals back here in December of last year. So we'd have to go back to the prior calendar year in 2022. And on December 8th and December 9th, back-to-back days there, we had those little green dots show up because you had the green, the blue, and the red lines all in the low reversal zone on the same day. Notice what happened immediately after that. Basically, it was a repeat of what we just experienced for the S&P 500. In other words, taking a look at SPX here, you had these 2 bullish clusters, these 2 green dots show up, and you had a straight up rally immediately after that. That was very aggressive, right? Not necessarily what you would assume would happen. You would assume that there's a reversion to the mean, but I will admit that this is much more aggressive than even I was expecting. Not that I'm complaining. Again, I love the fact that stocks are making their move here all of a sudden, but you always kind of move forward with certain expectations based upon how you're reading the charts and technical indicators out there. So with USO, we also had a very aggressive move after those 2 oversold cluster signals back here in December of last year. Could we be on the verge for another type of a situation like that right now? I don't know. For some reason, this feels a little different to me. One thing that comes to mind is that for whatever reason, it doesn't feel like we are in a plummeting oil environment. We finally started to get gas prices close to $3 out where I live. And for the longest time in the last couple of months, we were up closer to $4.50. So I think there's some sort of a weird mind game that's happening in my head right now that's preventing me for recognizing that we're in oversold territory right now, because in my own head, I feel like we're still having stubbornly high oil and gas prices. But, the proof is in the pudding. And we do see that little green dot showing up. So if we are about to have some sort of a bounce, maybe this is that green shoot that you would be looking for right there. But you'll notice that prices on USO right now are a lot higher than they were back here a year ago. So it's hard to get behind that idea that we're so woefully oversold with oil, but at least in the intermediate term, according to these indicators, we are. So keep your eye on the possibility of a reversion to the mean move back to the upside in the short term on oil. Over here, back to our 12 grid again, the US dollar, as you can see, also has the dark pink background color. So it's the third of those 3 that we just discussed. Notice that the dollar is now trading below its moving average as well, which has only been the case for 3 days out of the last 3 months. And those 3 days are the last 3 days. Every single day prior to that, the US dollar was above its rising 30-day moving average. So there, similar to what we saw with interest rates over here, there seems to be a bit of a sentiment change where there is more bearishness entering into the system. Now, unlike Treasury yields, which fell again today, the dollar actually rose today. It was actually a pretty decent move, up 0.34%, but it was not enough to offset the selling that took place there last week. So that's why the background color stays pink for the moment, but we'll keep our eye on that. But point is, when you have the U.S. dollar, and oil, and the 10-year Treasury yield all with pink backgrounds, that is what we would call wind in the sails for stocks, right? Because as I've mentioned countless times over the years that you guys have watched these videos, remember we've been doing these free videos on YouTube for the better part of a decade at this point, both here at Market Scholars and then previously when David and I were with TD Ameritrade with a similar video. So many of you know the gist of this. You've kind of been trained, you've been with us for a long time, but for those that are brand new, because remember there's always new people that are stumbling into these videos as well, so we have to do our best to kind of cater to multiple types of folks out there. Remember that the US dollar, when it is strong, is generally a bad thing for stocks. First of all, it's directly a bad thing for foreign stocks in most cases because you have to convert those different currencies back into dollars, and when the dollar is strong and the other currencies are weak, it makes it look like the performance of those foreign securities is weak. But the same concept, just in a slightly different way, affects many US stocks as well. The United States is blessed with having a lot of world-dominating businesses that happen to be headquartered here, but earn many, if not most, of their earnings overseas, right? If you think about companies like Coca-Cola and McDonald's as an example. Yes, they are big companies in the United States, but we are just one of 200 countries out there. And McDonald's and Coca-Cola, of course, are in dozens, if not hundreds of countries. And therefore, most of their profits are actually in other currencies. So when the US dollar is too strong and you need to report earnings upon your sales and earnings from other countries in those currencies, and they need to be translated back into US dollars when US dollar is strong and the other currencies are weak, it makes it look like their profits are weaker as well. So that's part of the reason why we don't necessarily want to see the US dollar strong. If you're a foreign traveler, perhaps a US traveler that travels to foreign lands, you like to see that because it means your personal buying power is looking pretty good there overseas. But if you're a US based investor, usually you want the US dollar weak, not strong. And so that's kind of the opposite of what we've been dealing with here in the last 3 months up until the last week. With oil prices, that should be pretty obvious as well. Remember, oil impacts the profitability of most other sectors that are out there. Usually there's at least at a minimum, a transportation component of nearly all other sectors out there. When oil prices are high, you can imagine that profits get pinched, right? The airlines is one example, which would be in the industrial sector. Jet fuel is going to be one of your biggest costs of running an airline. So when oil prices are high, there's a good chance that jet fuel prices are high. And if the airlines can't pass that along with higher ticket prices, then their profits are going to get squeezed. And so oil prices being stubbornly strong is usually bad for other stocks. And then with the U.S. Treasury yield, again, that should be fairly obvious. But when interest rates are rising, many companies borrow money, right? Most companies are not debt-free. There's a handful that are, but most companies borrow money. And so when interest rates go up and that debt needs to be refinanced at the then prevailing rates, if those then prevailing rates are higher than they were 3 months ago and a year ago, then all of a sudden your profit margins could get squeezed there as well. So this is actually a good sign when we see all three of those charts with a bearish color as they are right now. All of the other charts, as you can see, are green, which is generally speaking a positive, wind in the sails for the markets in general. Gold was down a little bit today, 0.41%, but remains with a strongly bullish posture above its rising 30-day moving average. No surprise that bonds were up across the board. TLT, the long-term U.S. Treasury bond, was up 1.5%, which is a pretty decent sized move. Remember, anytime interest rates are lower, you should assume that bond prices are up. Those two are inverse to one another. All of those bond categories, strongly bullish postures, and in the case of foreign bonds and high yield bonds, both of those are above their rising moving averages right now. TLT is still above its falling moving average at the moment. Bitcoin remains resilient. Remember, Bitcoin has had a remarkable move in the last few weeks. Most of it was made last week, and in the last 5 days or so, it's just kind of held the line at those heightened levels there. But Bitcoin at around 35,000 remains one of the more bullish charts out there as well. And then on our top rung, you'll notice that foreign stocks and from both a developed and an emerging perspective were both down today. And remember, that's probably because the US dollar was up, right? So while the US dollar's intermediate posture is bearish, today it was up. And oftentimes that has a negative impact on those direct foreign indices. So no surprise that EFA and EEM were both down today, despite the S&P 500 being up. And that's largely because of the translation of currencies back into US dollars. Let's take a look here at our sector 12 grid now, and that'll be chart 5C. And as you can see, things look quite interesting compared to the last time we've had an opportunity to look at these in my videos. Now we have all of these charts green except for one, and the one that's not green is the one that was the most resilient about a month ago, and that is energy. So again, going back to my comment that I had made before on the sector selector, that's part of the reason what we're witnessing right here, right now, is part of the reason why I feel like its positioning is very precarious there, and it's more likely than not to fall because this is falling. Now keep in mind, this measures something slightly different than the sector selector. It's measuring a different time frame, but more to the point, it's measuring, in this case, XLE is market cap weighted. The sector selector is equal weighted. So there are some differences there. Remember, XLE is going to be dominated by Chevron and Exxon. And a lot of the other smaller energy companies have very little sway in the overall indice there, the index there. So anyway, there are some differences to that, but just be aware that from a market cap weighted perspective, energy looks pretty bad right now. This is actually a 3-month low that it touched today. This is 3 days in a row to the downside for energy in the exact same time period that we're in the midst of a 7-day upswing for the S&P 500. So, what is being lost at energy is being found in some of these other areas, right? Money rotates, and some of that money is coming out of energy and is being pushed into other areas like technology here at the moment. You'll notice that technology was the second best performer today behind discretionary. Discretionary was up 1.12%. Technology nearly matched it, up 1.09%. So they were basically tied today. But of the two charts, technology to me looks stronger from an intermediate perspective, and I guess you don't need to take my word for it. We can just read in the label there as well. The intermediate line on technology is at 85. It's only at 65 on discretionary. But just look at the difference between where technology is trading right now versus its moving average. There's a tremendous gap right there, distance, air pocket between those two, whereas it's much more moderate here with discretionary. Discretionary just changed its moving average color to green today, whereas technology did it like 5 days ago. So to me, technology is one of the leaders here from a market cap weighted perspective, even though it was the second best performer in the market today. But remember, it's technology, communications, and discretionary where all 7 of our Magnificent 7 are held. And it's no surprise that all 3 of those sectors are trading above their rising moving averages with strongly bullish postures right now, based upon what we saw out of the Magnificent 7 in the last couple of days. Some of these other charts, a bit more hit and miss, right? Energy looks pretty precarious here at the moment. Even the interest rate sensitive stocks at the bottom look a little bit dicier. Yes, they have green charts, but the moving average color in most of their cases is not green. So we have to acknowledge that as well. All right, let's go ahead and now talk about our trade application example. Let me pull up chart 3A here. And what we're going to be looking at today is Comcast. Ticker symbol CMCSA, one of the rare, common stocks of size that has 5 letters in its ticker symbol. Anyway, Comcast caught my eye today because it was setting up as kind of one of those bearish rollover types of trades. As I mentioned before, we have, I think it's 8 open trades going right now, and previous to this bearish trade that I did here with Comcast that I'm about to present to you, we had the bearish trade on, I think it was Abbott Labs was the other one. Otherwise, all the rest of our trades were bullish. And remember, I did most of those bullish trades when the market itself was bearish in anticipation of some sort of a response and a bullish recovery, which we are now seeing. So we are now thankful that we were brave enough to take the bullish trades in the last couple of months, because we're now being rewarded for that bravery now that we've had this 7-day upswing. So you guys have probably noticed over time that I'm not afraid to take the other side of the market. In other words, today the S&P 500 was up, but knowing that the 7 trades I had on in this trade presentation account prior to today's trade, 6 out of those 7 were bullish and only 1 of them was bearish, it basically means I should be going out of my way to try to balance the scales a little bit. So that's part of the story here. And remember, my portfolio is going to look different than each of yours, so you might not be thinking in this regard, but some of you might be wondering, well, if the markets are doing so well and up 7 days in a row, why are you doing a bearish trade? And the reason is we try to keep some sort of balance. Just like we were rewarded for taking our bullish trades in the last month and a half when the markets were bearish, maybe we'll get rewarded for taking a bearish trade right now when the markets have swung more bullishly. Then again, maybe we'll get burned by it. We never know. Of course, the future is unknown. But why this one caught my eye, and so this was just a normal short sale. So this one was not an options trade. I had considered it because Comcast is the type of company where you have decent options liquidity, but I opted against it in the end because I would have had to go out to December or January, and in that case, I kind of was a little bit paranoid that we might still have a further upswing as a result of seasonality and the Santa Claus rally and all that kind of stuff. So instead, I opted to do just a regular stock trade, hoping that maybe we have a quick little pop lower before having a further advance into the year end in the market. By the way, Comcast, from a cable company perspective, was not alone in this regard. Another company I had my eye on for a bearish trade today was Charter, CHTR. Kind of has that same look to it, where you had this extreme sell-off that was stopped by its earnings. You had this extreme recovery, and now it looks like it's rolling over again. So this kind of seems a little bit systemic within kind of that cable business. Some of you might have also seen what happened to Dish here yesterday. It was like the worst performer in the S&P 500. It absolutely got annihilated. And yes, satellite dishes are slightly different than cable companies like Comcast and Charter, but they all kind of are part of the same ETFs and different things like that. So anyway, that may be part of the story here as well. Comcast is a really good business, right? And one that is excellent for long-term dividend growth investors. But what we care about here in this video at the moment is, from a short-term perspective, what do we see in the chart? And what I see right now is a background color here on chart 3A that's gone from blue here yesterday to pink today, telling us that this blue line has fallen out of the upper reversal zone. You'll also notice that we had a peak in the blue line right here on Halloween. We had a follow-up peak here on November 3rd. Notice that follow-up peak is slightly lower than that initial one there on Halloween, yet the 2 candles associated with that right here and right here, price of the stock went up when there was an underlying deterioration of the technical indicator. So that's what we would refer to as a bearish divergence from a near-term perspective there as well. So you can kind of see the levels where I've got my brackets set. So I do have a stop loss slightly above the high of the candle 2 days ago, and on a 1-for-1 reward risk relationship, I want this stock to come down here to just barely below 41 to try to lock in gains if the market is accommodative to me. You can also see that it's underperformed the S&P 500's dotted gold line here for the last 3 months of this chart as well. So that's all it was, a pretty basic short sell there for you today. I hope you enjoyed the presentation. If you like these hour-long presentations where it allows us to kind of let some of these concepts breathe a little bit more as opposed to being so rushed in just 15 minutes, as always, I urge you to do one thing, and it doesn't cost you a single penny, it just costs 5 seconds out of your time. Every single one of you who are listening to this video have the ability to do it because all of you are listening to this video on the internet. And if you're on the internet, it means you can sign up for Twitter for free, even if you're not on there right now, just like George did. So if you want to help us, that would be wonderful. David and I would certainly appreciate that. If we're up and over 100 likes by the time I'm scheduled to do this video again on Thursday, I'll be happy to give you another hour-long presentation. On the other hand, if you think that these are getting a little bit long in the tooth and would prefer the 15-minute ones, then don't click like. And if we're under 100 likes, then we'll keep it nice and short for you on Thursday. So we'll let you guys decide collectively, but whatever you do decide, thank you for checking out tonight's video. Best of success with your trades and your investments. Goodbye for now.